Good day, fellow investors. The quarterly market overview that we borrowed the slides from JP Morgan, great slides there, do a bit of marketing for them, they said, so they're not angry from me looking at their slides. Let's start with an overview. We'll discuss the expected returns going forward, also the biggest risks to the general market and investing in general, the economy, the Evergrande fail, is it really a fail? Interest rates, of course, the impact on the market, and the market in general, investing, and a little bit about where to look for those essential investing values that we discussed yesterday. So if we look at the S&P 500, we have been enjoying the best bull market in history, where over the last 10 years stocks have been going nothing but up, up, and up. And I still read in the comments how the market will give you 10% no matter what. And I think that is one of the biggest risks when it comes to investing, because real returns will not be 10%. That's a given. Let's discuss a little bit the economy and everything, and you will understand my reasoning. If we look at the economy, if we look at the growth there, these are real numbers for the US GDP, and you can see how the trend there is 2% growth. It has been a little bit more exuberant in the 2000s, then the crash, in trend, and we are still, due to COVID, below trend. Of course, the expectations are there for growth, but this is it. Western countries will grow at best at 2% in good times, with very negative situations in bad times. This is because if you just look at the drivers of that long-term growth, population is going down, so you can't expect miracles, and money is being printed. Now we'll see inflation, and there is really not much that can be done there. That's it. Real growth has been very low over the last 20 years, and it is expected that it will be even lower in the next 10 years and going forward. This is it, which means that apart from the financial engineering, this is the reality we are living in. And to counter for the reality, because nobody ever wants to deal with the reality, we are humans, that's likely a trait of ours, we see that the government, in this case the US, but also across Europe, is borrowing 21% of the budget. That's insane. But despite the 21% budget deficit, the budget office is still projecting minimal government debt increases in the future. This, I don't know how they will have just a 5% increase in government net debt with 10, 15, 20% and continuous 5% budget deficits over the next 10 years. So this is, of course, a ridiculous story, but as long as you drink the Kool-Aid, they will keep selling you the Kool-Aid. And if we look at reality, just look at the financial engineering. This is the ratio of US financial assets to GDP. Over time, it was 2.5, exuberant, free, then 2.4, 2.3, and then interest rates going down, borrowing like there is no tomorrow, and even more borrowing like there is no tomorrow, because they had an excuse, in this case, what has been going on in the last year. Now it's 5.6, and actually nobody cares. So this is actually very, very sad, but we are in this world, and eventually this will revert. It has reverted from the Roman Empire, from whatever government you look in the past. This is simply not sustainable, and also the biggest risk when it comes to investing. Of course, now, after they have been telling us that there is no inflation will be low, transitory, blah, 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 just try to buy anything and you'll see inflation. And now also this week has been announced by the Fed that, oh, there is inflation, 15% inflation. Now people finally see it. So I wonder what will come next, because This is the game, this is the name of the game. Now they have increased their projections from interest rates, but if inflation is 15%, 1.75 interest rate will not do much, especially as people continue this spending spree. So these are just projections that are, this is the Kool-Aid. We'll do this, when we lose control, then we are all screwed. And if just this happens, so this is 2013, the yield curve, and this is 2020, now it's a little bit higher already, so we are here, 150. If this goes to double here, you can expect a market crash of 50%, especially if people fear even higher interest rates. That's the name of the game, and nobody can predict it, no matter what they tell you. They tell you, yes, we are slowly starting to lower the bond purchases, but this is still buying, this is still a plus. Just here a little bit, there was one small negative before the current situation, so they already inverted that, which is insane, but they are just going to print forever. This is for the next 2 years at current levels. There have been some hikes, some rate hikes, but in case of a crisis, what do you think they will do? Let's say in case of a 2023 recession, what do you think they will do? They will print more, which leads to hyperinflation. I'm not saying, I have no idea what will happen. I'm just describing the risks of what will happen, as I've been doing over the last 2 years, 3 years, 4 years, and now, lo and behold, it's happening. But what can I say? It's about following the news or just looking at the fundamentals and investing accordingly, as we have discussed in those investment essentials. By looking at these fundamentals that we just discussed, the risks, you want to be as far away from those risks. And if I can give you any value, if I can steer you away from risky things, then I've done my job perfectly. Earnings have been announced to go higher and higher, really expected great earnings, but look at this debt from corporations, from anything. If interest rates go higher, this is trillions. If interest rates go up, I don't know, 5%, that's 5-6 trillion. That eats up all the earnings that are there. So earnings might even not grow forever, and that's another big risk that you see when you look at these fundamental charts. Further on Evergrande, everyone says that it's a big systemic risk, it's a big crisis, but if I look at Chinese growth, they have had no decline in 2020, then whether this is 18, 15, 10, who cares? It's big growth and still charging higher and higher. Of course, they have still deficits, but compared to higher growth, it's a little bit easier. And when it comes to Evergrande, what did the Fed do in 2009, 2008 in a similar crisis? They bailed everybody out, they pumped so much money in the system, and they practically made you, if you're from the US, but also in Europe the same, made us more in debt to the future, lowered the real value of all our pension funds, of everything, to zero, interest rates zero, destroyed natural market forces, but pushed financial assets to the sky, everybody happy, everybody rich. The thing is, I see Evergrande as a success. They let them fail, and that's a show of power, a show of strength, because they are saying, we're not bailing everyone out, we are not saving and printing just to save everyone. There is an end to the greediness. So that's a different perspective. And if we in the West would understand that, perhaps we would be a little bit less richer now, but we would be much, much richer over the long term. Unfortunately, we will not. And on the market, to close with this very, very important chart, but I think mainly overlooked. If you look at the clicks and what drives the current social media, look at the investment flows by income. Who is increasing investment flows? Those that make 0 to 20K a year have increased in 2021 the investment flows. I don't think this counts cryptocurrencies or whatever, by 4 or 5 times. So now we can say that everyone is playing in the stock market, and those that make a lot of money, it's practically in line with historical averages. But those that have little money are really gambling in the stock market. And we all know how this party usually ends. To protect ourselves, go back to the video of yesterday, look through your investment opportunities, and look for those essential investment returns. I've been finding them, of course, in commodities. Those were giving essential returns a year ago, 2 years ago, did really good there. Now there are emerging markets. China is, don't touch China, but the essential returns are there no matter the risks. Also in other pockets of the market, also in Western hemispheres, and we'll research more. As I do research, I'm happy to share that, so please subscribe and smash that notification button, because I'll maximally do 4 videos a month. And check my research platform if you are interested in my portfolios, my research, my strategies, and everything that I do as a stock market researcher. The price is going up soon, so lock in the current yearly subscription forever. Thanks for watching, and I'll see you in the next video.